أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله السلام عليكم ورحمة الله. So this is our 11th class. We only have 4 more classes left. One of them is the second exam, the other one is the contest. So we have 2 more chapters after this, and then we have the final exam. So we are going to meet, inshallah, 5 more times after this, inshallah. Okay. All right. Now we're going to talk about something very simple and easy today. It's not difficult at all compared to what you have studied before. The depreciation calculation may be a little bit involved, but not too difficult. So we're going to discuss long-lived assets, and they fall into 2 different categories: tangible assets and intangible assets. Tangible assets and intangible assets. So let's jump into the first category. The tangible assets, they're also known as property, plant, and equipment. Right? You remember this title in your financial statement: property, plant, and equipment. Property, plant, and equipment. They're also called plant assets. They have physical substance, meaning you can physically touch it. It's a building, it's a computer, it's a truck. They're used in operations, and they are not intended for sale to customers. So this is something that you're going to use in your business to operate your business. You're in the business of selling computers, then that is what? Is that an asset? What type of asset is that? Is that equipment? It's inventory. Very good. It's inventory. If you're in the business of selling, if you're business of selling trucks, for example, or cars, right? That's inventory. But if you buy a truck to use in your business to deliver goods or bring items, etc., then that's an asset. That's a planned asset that you depreciate. So we are expected to provide service to the company for a number of years. Except for land. Land does not have a limited life. It has unlimited life, right? Meaning, of course, you know, until Yawmul Qiyamah. But for our purposes, for the business, as long as the business will be there, the land is going to not reduce in value in the books. There is no depreciation of the land. Land is, if you buy a land for $1 million, you put it on the books for $1 million, and it stays at $1 million until you sell. If it increases in price, in market value, generally accepted accounting principles does not allow you to increase its value on the financial statements. So if the fair market value increases, you cannot increase the price of the item in your financial statement. They are recorded at historical cost. They're recorded at historical cost, meaning whatever you paid for them, they're recorded at that price. Okay? The price of the land the price of anything can reduce, right? Land is no different, but usually that is not the case with land. Usually the price of the land does not reduce. Okay? Usually it does not.
When we used to see financial statements, like how come they include that as a depreciation? But now I understand it's related to anything other than that.
Right. Depreciation is for everything else other than land. Okay. Now here is a chart of different companies. Wendy's, you know, Wendy's is a burger shop. There are a couple of locations, I think, in Qatar, if you have seen Wendy's. Anyone of you seen Wendy's? It's there is one there. There is also one a little bit further down from Darussalam Mall. There is a couple of them, right? It's a burger chain, just like McDonald's and Burger King and so forth. Wendy's is at the corners, and you know, of the streets in the US. This is, they have, their planned assets are 73% of their total assets. JetBlue, as you can see, there's also a 69%. And you come down to someone like Microsoft, right? Their planned assets are only 3% of their total assets, because they don't have a physical production facility like, for example, Toyota or other companies like that, where they have a lot of physical equipment that is used to make things, manufacture things, and so forth, right? Microsoft, their computer resources are there and so forth, but the planned assets are only 3% of their total assets. Say that again. Walmart, 50%. Why do you think it would be more? Walk into the Walmart store. Most of what is inside Walmart is what? What type of asset? It is, but what type? When you walk into Walmart, inventory, what you see is what? Most of their asset is inventory, it's for sale. The shelves and the refrigerators, they're just a few, they're not for sale. Most of the stuff they have in there is for sale. This is inventory. You see, they have a large amount of inventory, right? Follow. So you see, when you walk into Walmart, all you can see is things for sale. It's inventory, it's not planned assets. They have billions of dollars of inventory, right? Compared to the shelves, for example, the hangers where the clothes are hanging and the counters and so forth. What is this? Nothing compared to the amount of inventory they have. Does that make sense? Think about the inventory they have. Think about the televisions they have. Think about the computers they have. Think about the treadmills they have. Think about the truck. Think about the lawn mowing equipment they have. All that is expensive, right? But it's all for sale. The inventory, not. So this is 53%. 53% is planned assets. The other is. So this is just items that you put on long-term assets and you depreciate. Buildings, right? Trucks, things like that. Huh? It depends. It depends. What is McDonald's primary business? Making people fat? McDonald's primary business, McDonald's franchisor company's primary business is real estate. Their primary business is not selling burgers. The franchisee, the person who buys that franchise and sells the burger and gives McDonald's royalty, their primary business is selling the burgers. So if you go and buy a franchise of McDonald's, they're going to teach you how to do that, and you will make money from that. You'll give 3%, 4%, 5% to McDonald's. That's not their primary business. Their primary business is the rent that you're paying them, with which they are buying the land underneath the shop. That is their primary business, the real estate. They're going to own that land with the money that you're going to make by selling the burger. They're just going to teach you how to do that. Okay? McDonald's primary business is real estate. No. Look, you understand this? If I open if I build a building and I rent it out to 5 different people and they have their own shops, right? Some of them might have difficulty paying me rent with which I'm supposed to buy this building that I have took out a loan for. If I teach them a good business from which they can make the money and give me the rent so that I can buy the land, right? It's a very good model for me. So McDonald's owns most expensive corners of real estate in large expensive cities like Chicago and Houston and New York and so forth, and they buy that land with the guy's money who's selling the burger. And they show them how to do that business. That's it. Right? Anyhow, this is sidetracking. Let's go back to our main topic here. The item is placed in the balance sheet. It's recorded at historical cost. Whatever you have paid for that item, that plant asset is recorded as the value of the asset, and it includes all expenses to get that asset ready for use. And we're going to talk about this some more. If you bought an equipment and you had it delivered to you, the cost of the equipment as well as the cost of shipping together is recorded as the asset. Okay, and we're going to look at this detail, what else is included and what is not included. If you buy something that is small and it does not have a long useful life, you just expense it and it goes into the income statement. But if it has a long life and it has a large value, then it goes to the balance sheet and you depreciate that over the number of years that you're going to be able to use that property, the useful life. It is called the useful life. I mentioned to you one time that, for example, this garbage can, right? It's been here for 4 years maybe, right? It costs maybe 100 reals, 200 reals. It is not on the balance sheet of Qatar University, nor is it depreciated, right? I told you a number, if you remember, 20,000. If the asset is less than 20,000, it's just expensed. 20,000 reals, it's just expensed. So none of these things, right, are on the balance sheet. They have been expensed. Although these chairs and tables, right? However sorry they have been here since 2011 fall, right? So I must say they're very, very strong because this is their 10th year, right? Follow. Okay. So this is called substance over form. When you do not depreciate something like this, although it's lasting you for a long time, because it's just so small, it doesn't make any sense to put that on the balance sheet and depreciate. How does the accounting principles define cost? Cash paid in a cash transaction or cash equivalent. So you could pay cash, which is very easy to determine because cash is equal to cash. If it's 10,000 reals, it's 10,000 reals. But if you pay something else, if you give something else in exchange for the asset, so if you exchange one asset with another asset, then you have to determine the fair value of one of the two, either the asset that was given up or the asset that was received, whichever is more easily determinable, right? Whichever is more easily determinable. So if you exchange a truck for another truck, right? Then whichever one is easily you can figure out the market value of, you use that, and then the other is calculated based on that. And usually if you trade, if you give an old equipment and get a new equipment, you have to give some cash with it, right? So there is a way of doing that. We're going to discuss how this is done and so forth. So the fair market value of one of these two assets must be known. For land, yes.
Example, you're giving an old item
a new one. So it is important to have a cash amount of it, because the other will be much higher than the. That is right. That is right. If you give up a new equipment and get an old one, you might receive cash. So either way, right, if you're getting cash or giving cash, there is a way of recording the journal entry. We're going to look at several examples, inshallah. Okay. For land, all necessary costs incurred in making the land ready for use, right? So if you buy a land and you want to use that land for a particular purpose, anything you have to pay for to get that land ready is included as the cost of the land. It could be things such as, obviously, the cash price, the closing cost as title, such as title, attorney's fee, any legal cost associated with buying the land. Real estate broker's commissions. If there is a broker, you might have to pay them a fee, a commission. Accrued property tax and other liens on the land assumed by the purchaser. So if there is any pending taxes, so let's say the old owner did not pay all the taxes and it was not up to date, and you have to pay for that, right? That is also going to be part of the purchase price of the land. Take a look at an example. Assume that Hayes Manufacturing Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is raised at a net cost of $6,000. So they buy a land and they pay $100,000 for that land. There is an old warehouse, a building that they don't want, so they demolish that building, and it costs them $7,500, and the the scrapped material from that demolition is sold at $1,500. So you can sell that. You can sell the old material. There are companies that buy, they can reuse that. So they sold it for $1,500. So the net cost of doing that is $6,000. Okay? Net cost of getting rid of that building is $6,000. Additional expenditures such as attorney's fee is $1,000, and broker's cost is $8,000. So how should this land be valued? You have the $100,000 for the price, $6,000 for the removal of that building, $1,000 lawyer's fee, and $8,000 broker's commission. Total $115,000. So when you record land as an asset on the balance sheet, it will show as $115,000. So that is the cost of that land on the balance sheet, $115,000. Is that clear? Okay. Then you have something called land improvements. Land improvements are driveways, parking lots, fences, landscaping, underground sprinklers. Now, these are they're not considered buildings, right? So if you make a parking lot, you put parking and you put parking shade, and you put some fences, and you make a sidewalk, let's say, in front of your building and so forth. These are called land improvements, and they have a more limited life compared to the building. You know those sidewalks, every few days you see people coming and they're, breaking it down, fixing it, repairing it, putting a pipe underneath the sidewalk, and so it's going to have a long life, right? So depending on how much it costs and so forth, you could possibly expense it. For example, if you fence, right, an inexpensive fence around the land, demarcate that this is your land, not like full walls and so forth, inexpensive. So you can expense that. So it's flexible. You can expense it if it is expensive and it will last you for a long time, like boundary walls, really solid 10-inch boundary walls and so forth, right? With decoration and so forth. I mean, you might want to depreciate that. So it depends on what you're spending, how long it will last, right? You could either expense it or you could depreciate it. Does that make sense? I mean, capitalize it. So So expense and capitalize. When you say the word capitalize means you put it on the balance sheet, right? Expense, it goes in the income statement. Capitalize, it goes to balance sheet. So anything you capitalize, you depreciate. Okay? For buildings, it includes all costs related directly to the purchase or construction. So you could buy a building or you could build a building, right? When you're driving down the roads of Qatar University, you see many buildings are being built, right? New buildings. So if you purchase a building, the purchase price, closing cost, and commission, so same as the land, right? Whatever you paid for the building, any legal cost, any broker's commission, remodeling and replacing or repairing the roof, floors, electrical, wiring, and plumbing. If the building, when you buy the building, if it is not ready for use, right, you cannot go in and you can use it immediately. You need to make some repairs and get it ready. You need to fix maybe the bathrooms or the roofs, or some things are broken and so forth. You need to fix it. When you initially buy, right, when you initially buy, you need to pay to get some things fixed before you can use it. That is part of the cost of the building. Does that make sense? So any asset you buy, any cost that you pay to buy, and get any cost that you pay, that you incur to get it ready for use, right? It's included in that, the cost of that asset. If you construct a building, then the construction price, the contract price, the architect's fee, the building permits, anything that you have to pay, right? If you dig the ground, have to dig the ground, sometimes you have to do deep excavations, right? Because the land is soft, so you have to dig deep and you have to pack the land, right? You have to pack the land. Sometimes this is called piling. What you have to do sometimes is the building is on a land that is too soft, and if you build the building on that land, the land will sink. Okay, so what you have to do is you have to dig and you have to pack the land. You have to press the land until it becomes tight so that your building will not sink. You follow? So all of these things, anything that you have to, you might have large rocks that you have to remove. I mean, anything that you have to pay to build that building and get it ready for use is going to be in the construction cost. Okay. For equipment, all costs to buy and to get it to your place of use and to get it ready for use. So the purchase price, the sales tax is VAT, value added tax, freight charges, anything that you have to pay to get it to your place if you're paying for it, insurance during transit of the item, expenditures required in assembling, installing, and testing the unit. So maybe you have to build a platform, right? The equipment comes, you put the equipment, you cannot put it on the ground, you have to put it on a 1 feet high platform. So let's say you build a platform, 1 feet high platform with bricks, and the equipment goes on there. The cost of that is included, considered equipment. That equipment would have that cost included in it. So anything that you pay to buy, to get it in your place of business and get it ready for use. So anything you're paying for until you press start goes into equipment. Okay? When it's on the way to your location, sometimes it's very expensive equipment, you have to insure so that if something happens on the road, the insurance company will bear the cost. Okay? Follow. Okay, let's take a look at an example. This company purchased a delivery $22,000. Sales tax $1,320, painting and lettering $500. So, you know, painting the door or the side of the truck with the company name, logo, etc. Motor vehicle license $80. So motor vehicle license is the annual registration is the SMR of the truck, $80. A 3-year insurance, this is after the truck is purchased and they're driving the truck, the insurance is for that, right? So this and this license will not be included. So what is included? The sales tax and the painting and lettering, okay? You following? What will be the journal entry for us? We will have the equipment, which is 23,820, which includes this price, this sales tax, and this painting. And then you have expense of license fees, and then prepaid insurance of 1,600, which is for 3 years. Is that clear? Right? You following? So the 80 and the 1,600 are not included. The purchase price, the sales tax, and the painting is included in the equipment in the truck, which is 23,820. The $80 is an expense, and the 1,600 is a 3-year insurance, which goes into prepaid insurance. Is that clear? So when we record the entry, this is how it shows up. This goes into the 23,000 equipment goes into the long-term asset, property, plant, and equipment. This $80 goes into the income statement as an operating expense. You're all familiar with these sections of the financial statements. Prepaid insurance goes into assets. Which type of asset? Current assets. Very good. Excellent. Now, there are sometimes there is an option to lease instead of buy. You could lease, which is basically renting. If you lease, if you rent instead of buying an equipment, then you just lease it for a period of time. So let's say you lease an equipment, or you can lease a car for 3 years, 5 years, and you just make a monthly payment. After that period of time is over, you just give the car or the equipment back. It's basically renting. So what happens here? The advantages listed here are reduced risk of obsolescence. So you're renting it, so you don't have to invest a large amount of money. And if it goes out of date, if it becomes obsolete, meaning that equipment is so old that you cannot sell it anymore, it's out of design. Many new equipments have come out after that. You don't have to worry about that. You just return it because you're only paying a rent to use that. Little or no down payment, so you don't have to pay a lot of money from your pocket up front. You use it, you pay a small rent, and you can manufacture items and you can make money from that. Share tax advantages, right? And again, taxation, it's a different animal. We don't want to get into that, but there are some tax benefits in some countries for leasing. Assets and liabilities not reported. So this is not, the equipment is not listed in your balance sheet as an asset because you don't own it, right? You don't own that, nor do you have to worry about depreciation. You just expense the rent as an operating expense. Rent expense or lease expense, that's it, finished. There is, however, one type of lease that is called capital lease. And there are certain conditions of capital lease. If it is a capital lease, what we talked about before this is called operating lease, when you just pay the rent and you don't have to deal with putting it on the balance sheet or depreciating or doing any of that. It is called operating lease. Capital lease is when you, although it is considered lease, you're paying the rent every month, you have to put that on your balance sheet and you have to depreciate that. And there are certain conditions that make a lease a capital lease. Okay, there are certain conditions that make lease capital lease. You don't have to remember what I'm saying right now, what makes it a capital lease, but I will just tell you what makes a lease a capital capital lease. When is it considered a capital lease? There are certain conditions that make a lease capital lease. One of those conditions is the rent payment, the lease payments that you're making every month, right? If you add all of that for the 3 years or 5 years that you're going to rent the equipment, they are equal to 90% of the value of that asset, right? So if it's $100,000 equipment and you're paying rent, by the end of the lease term, you have $90,000 that you have paid in rent. So 90% of the value of the asset, it becomes capital lease. That's one condition. Another condition is if you keep the asset for 75% of its useful life, right? So let's say the equipment is going to last for 20 years and you're going to use it for 15. 75% of its life you're using, it becomes a capital lease automatically, okay? Another condition is if you have an option in the lease that says at the end of the lease term, you can buy the equipment for a token price, right? So maybe the lease says that at the end of this, you can buy the equipment for $1. Follow. That makes it a capital lease. Again, we are not into lease accounting. There is a lot of stuff. I just gave you the surface. There's a lot of stuff between operating and capital lease. For our purposes, there's operating lease, you pay rent, and there is this thing called capital lease. If it happens, you have to put it on the balance sheet. Okay? In operating lease, you are not going to put the item on the balance sheet. You just expense the rent. Right? Okay. Now we come to depreciation. Depreciation is a process of cost allocation and not asset valuation. Meaning, if you buy an equipment for $10,000 and it has a useful life of 5 years, and you use straight line depreciation, and you're recording $2,000 as depreciation expense every year and recording $2,000 as accumulated depreciation every year, accumulated depreciation. That doesn't mean that your equipment reduces in value $2,000 every year. It's just spreading out the cost of $10,000 over a period of 5 years, during which this equipment is going to help you earn revenue. So you want to match the expense. Remember the matching principle we discussed 3 years ago? And we said revenue must be matched with the expenses. That's the whole idea of depreciation, right? That's the whole idea of depreciation. It's not a cost. It's not asset valuation. It's a cost allocation. It applies to everything except land, and the depreciation is there because the more you use the equipment, the less it can do for you. The slower it becomes, the more repair it takes, right? The more times it does not want to start, the more time you have to take it to the mechanic. You have used all used cars. After a few years, it starts to cough and sneeze, and you have to take it to the mechanic often, right? So just like that, any manufacturing equipment loses its production capability as you use it, right? So you have to simultaneously reduce the book value. The book value, it has got nothing to do with the fair market value. Fair market value is a different beast. We're reducing the book value. So here is a picture of, a new truck, and then after a few years, and then when it becomes salvage. Salvage value is after a few years, the price of the asset reaches the bottom and it does not go down much from that, right? So let's say you have a 2005 Toyota Camry right now, right? This is 2020. Maybe you can buy that for 5,000 riyals, let's say. 2005, it drives, let's say you can drive it, it starts, it drives and so forth. It's in okay shape, the seats are worn out, the body is not in good shape, but it drives. Well, how much more could it reduce? It's not going to become 10 riyals, you follow, right? So it has a bottom price, the asset itself. If the car drives, right, there is a bottom price. That bottom price is called salvage value, right? That bottom price is called salvage value. So when depreciation is calculated, the salvage value is subtracted from the purchase price or the cost, right? And the depreciation is calculated on the rest, because the salvage value will remain. It will not depreciate. It will remain after the useful life. If it continues to work, you keep that on the balance sheet for the salvage value, and you can use it until it stops working. There are different methods of depreciating. Straight line is the most popular one. As you can see, more than 80% of the companies use that. It's easy to calculate and it's the most popular. Then you have something called double declining, or declining, not double declining, declining balance. Declining balance allows you to depreciate more in the first few years, and the depreciation reduces as you use the equipment. So the idea is that the production capability of the equipment is not going to be the same during the first year and the fifth year. Follow? So if you depreciate 20,000, 20,000 every year, well, the equipment is more productive in the first year, right? So you might want to do, let's say, 30,000 in the first year and 10,000 in the last year, and then slowly reduce 30 and reduce that down. You follow, right? There are different methods of doing the declining balance. The idea of declining balance is the depreciation is more in the first years and it goes down, right? The third one is units of activity. Units of activity is based on how much can the equipment produce. So let's say you buy an ice cream machine, and the ice cream machine is capable of producing 1 million gallons of ice cream, right? So if you produce 100,000 gallons of ice cream in the first year, right, that means you will depreciate 10% of that in the first year. In the second year, let's say if you produce 200,000 gallons of ice cream, you will depreciate 20% of the price. The third year, if you manufacture 300,000 gallons of ice cream, then you're going to expense 30% of the price. You follow? So units of activity, and we will see exactly how it's calculated, but it's based on use, not time, right? It's based on use. So if you buy a car, and the car is supposed to drive 200,000 kilometers, right? So you divide the total cost with the 200,000 kilometers, and whatever you drove in the first year, you depreciate that, right? The second year, third year, like that. Okay, let's go to the first example. Wheel Speed's a small delivery truck. The cost is such 13,000. Salvage value is 1,000, and it's good for 5 years. So let's take a look at the straight line depreciation first. What happens? Very simple. The cost is 13,000 minus the 1,000 salvage value. So we will depreciate 12,000. Everybody follow? Right? All of you have done this in your exam last week. 12,000 divided by 5, 2,400 annual depreciation. Boom. This is going to be every year. Right? 2,400, 2,400, 2,400, and depreciation expense 2,400, accumulated depreciation 2,400. Simple enough. All of you know how to do this. You have done this. Then we have the twist where you might buy the equipment in the middle of the year, right? So you calculated monthly depreciation in the exam, remember? Right? So if let's say you bought the equipment at the, not January 1st, but April 1st, that means the 24,000 is going to be divided with 12 and multiplied with 9, right? Instead of 12 months, right? You're going to do 9 months. So instead of 2,400 in the first year, you're going to have 1,800, right? Right? It's 200 per month. So 2,400 depreciation a year. How much is it per month? 2,400 divided by 12 is how much? Rocket science. 200? 200, right? I know it's late in the day, but this is very simple, right? 24 divided by 12. Ooh, very good. Now, if I have 9 multiplied by 2, 18, right? So I don't have January, February, March. Those 3 months are gone. I have 9 months left. So 9 months depreciation is going to be 1,800. Right? Is that clear? Sir Muhammad? Clear? Which means the last year's depreciation is going to be only for 3 months, right? Which would be 600. Clear? Uh-oh, tell me.
You are buying in the first year, right? So what is the calculation? Because we are actually purchasing it in the first year itself.
You cannot purchase it in the second year. The year you buy it is always going to be the first year.
In this case, you were mentioning that it is purchased in 2014. So once it is purchased, so why do we do depreciation? Why are we doing that? Because it's actually purchased. So whatever you were mentioning, that is some sort of.
Depreciation starts from the very moment you start the button. Press the button start. Very moment you buy, depreciation starts from that very day. Right? Everything okay? Okay.
Why they go to 2019?
Yes.
Why do they go to 2019? Because 60 months, if you start, let's say you rent something on April 1st and you rent it for 1 year, when will your rent period end? March 30th of the next year, right? Right? So we have from 2014 April 1st to 2015 March 31st, the first year. The second year is from 2015 April 1st to 2016 March 31st. That's second year. Third year is 16 to 17. Fourth year is 17 to 18. Fifth year is 18 to 19. Right? Your MBA is supposed to take you 2 years, let's say 2 years. So you start in 2020. When will you end? 2022. So you have 3 years involved, 20, 21, 22. So you're starting in the middle. You start in the middle, 3 years will be involved, right? So if you start in the middle, a 5-year asset, it will go into 6 years, right? A part of the first year and part of the sixth year. Does it make sense? Declining, this is accelerated method, so your depreciation is going to be more in the first years. And there is a particular method in the declining that is called double declining. Double declining is using twice as much as the straight line method. So whatever the straight line method was, you depreciate it double the amount, right? The way it works is like this. Remember, in the previous example, we had, by the way, in the straight line method, you subtract the salvage value. But in the declining method, you don't subtract the salvage value when you do the calculation. And you depreciate double the straight line. So if the asset is good for 5 years, every year depreciation for straight line should be 20%. Double declining is going to be 40%, and it starts with the total value of the asset and not cost minus salvage value. In double declining, salvage value is not subtracted. Remember that, right? This is the rule, right? Why is that? Genius. You are absolutely right, right? Okay. 13,000 times 40% is 5,200. So that's the first year's depreciation. Now, this depreciation, accumulated depreciation, is subtracted from the cost. 13,000 minus 5,200 equals to 7,800. We take that and multiply that with 40%. Whatever we get is going to be the second year's depreciation. We subtract that from the remaining book value and we get 4,680. 40% of that is 1872. Subtract that from this, get 2,808. 40% of that, and so on and so on. Are you following? The 40% is double what you would have taken in the straight line, right? So you don't have to calculate the straight line for that. For example, if you have a 5-year asset, right? It's 100% in 5 years. 20% is going to be in the first year. If you have a 10-year asset, it will be 10% in the first year. That means double decline is going to be 10%. Does that make sense? Okay. Mr. Mohammed, you had a question? No, the idea of declining is if you look at the annual depreciation expense, it declines. It goes down and down and down and down. It is reducing every year. See, we are taking 40% every year, but of a different value. The book value, remaining value, is reducing because the depreciation is subtracted from the original book value. So we have the 13,000 in the first year, 40% of that is 5,200. We subtract 5,200 from 13,000 and we get 7,800. Okay? 13,000 minus 5,200 equals 7,800. 40% of that is going to be this number. Percentage is fixed, but the amount is not, because the percentage is applied on a smaller number every year. Does that make sense? Amount of depreciation, yes. Declines. The amount of depreciation goes down every year compared to the previous year. Does that make sense? You following? You follow the method, the way, the calculations, the numbers, where the numbers are coming from?
So we are calculating 5 years and estimated.
No. Estimated useful life, don't worry about the price. The percentage where it comes from. If if the asset is good for 5 years, forget the price, forget everything. The asset is good for 5 years, right? Right? Every year you will have 20%. One 100%, right? The entire life is 100%. If you divide that over 5 years, 20%, double declining, you take 40% of the remaining book value. Does that make sense? Right? We have to make things complicated, otherwise we will not have good jobs for accountants, right? Okay? Everybody could do it, then you know. Say that again.
Why do you take the
Double?
Yes.
It's double because it's double the straight line. 40% is double of the straight line. Straight line is 20%. Double is 40%. That's why it's called double.
In 5 years, but the double.
We're using 40%, right? Same 5 years. We're using 40% until we reach the salvage value.
What we have done in the straight line, we have taken 100%, and the depreciation, for example, it is 20%, so it's for the 5 years, straight line. But why we are doing this declining balance method? So are we taking this 100% or is it different value? Because if line is standing, it is 40%, so it is exceeding the 100%.
No, it's not 40% of the original price. It's 40%, you see, every year, 40% of a smaller number. If I did 40% of 13,000, in 2.5 years, it will become 0. But you see, it's 40%, but this number goes down. You see, how do we calculate this number? Can you tell me? How we calculate this 7,000? Where does this 7,800 come from? 13,000 minus 5,200, 7,800. 7,800 minus the 3,120, which is this. So you will take 40% every year until you get to this. The actual calculation is 6,674, but it is rounded to 685 to make the book value 1,000 at the end, because the book value will not go below 1,000. The book value cannot go below 1,000. Why is that? This is the salvage value. So it's given to us. The salvage value is 1,000 given to us. You cannot depreciate below that. Once you reach 1,000, you have to stop depreciation. After this year, you could end up using this same asset for 10 years. It could be used for 10 years if you use it carefully and it is maintained and so forth. But after the 5 years, there will be no depreciation on that. It will keep the value at 1,000 until you throw it away. Why is that? There is some philosophical logic behind it, which I really... Yes. The straight line, right? So it's a straight line. You subtract the 1,000 first, and you depreciate the rest. In double declining, you don't subtract the 1,000 first. You start depreciating, and then at the end, you stop when you have 1,000 left. No. We did not start at the middle of the year here, right? We did not start at the middle of the year here. You see, our original example was not the middle of the year. This is the original example. This is the original example, 14, 15, 16, 17, 18. This is the original example. There was an exception that I showed you. If we purchased it on April 1st, what would happen? Follow. This is the original example. We did not buy it in the middle of the year. We bought it at the beginning of the year. That is our example. Follow. So we are comparing this depreciation with the double declining. Say that again. Yeah, we are not. So the 2400 depreciation is subtracted on the balance sheet. The 2400 is depreciated, it's subtracted from the balance sheet every year from the 13,000. On the balance sheet, the asset is recorded as 13,000. And you're recording, you're reducing 24, 24, 24, 24, 24, 5 times. The accumulated depreciation is going to be 12,000. And the book value will be 1,000, not only.
So if we reach the 5th year and the book value is not 1,000, that means there's something wrong.
It cannot be in the straight line. It can't be, because you're subtracting 1,000 and you're taking the rest and you're dividing it with 5. It will go away. The whole amount will go away. With the declining balance, you have to do a little bit of adjustment at the end. Right? You have to, for example, we did $10 here, right? But it will work. It works out. The calculation works out, right? The calculation works out within 5 years. It does work out. Okay? Mathematically, it will work out.
Does this mean we might have done something wrong, or no? It just needs an
No, it just needs an adjustment. It will be whatever you need, get it to 1,000. Whatever is left, right, in the 5th year. Okay, and it's going to be less in all cases. It is always going to be less than previous year's depreciation. Okay. Now, if we compare, okay, we have one more method, and that is the units of activity. So we have $12,000 as the depreciable cost, and we have 100,000 miles. So here again, we're using the 12,000 and not 13,000. So in the double declining, we use 13,000. Here again, we use the cost minus salvage value. And this truck that is going to drive 100,000 miles, we divide the $12,000 with 100,000, we get 0.12. So 12 cents for every mile the truck is driven. So in the first year, let's say you drove the truck 15,000 miles, and you multiply that with the unit cost of 0.12, 12 cents, and your depreciation is going to be $1,800 in the first year. It depends on how much you drove the truck. This is the useful life of the asset, not years, right? Not years, right? Now, you know, maybe it will last. It might last you 5 years. 100,000. It does. Years are not an issue here. It's the number of miles. Okay. Now, you know, anyone here bought a brand new car? Brand new. Brand new. Okay. The warranty is for how long? 4. If you drive those miles before 3 years, alas, warranty is gone. You follow, right? So let's say they say it's 60,000 kilometers or 3 years, whichever comes first. right? So if you drive 60,000 kilometers in 2 years, warranty is finished, because now this car will start to have problems, right? Or if you don't drive 60,000 kilometers and you have kept it for 3 years, even then it's finished, because after 3 years, even if you did not drive, so you have two different ways of doing this, right? The depreciation or the valuation. One is usage, the other one is passage of time. The two depreciation methods that we looked at, both were for passage of time, no matter how much or less you use it. How little you use it. This is based on how much you use and not how many years you have used it. Does it make sense? Now, 15,000, this is actual miles driven, right? Actual miles. The car will show how many miles you drove during the year. Depreciation recorded at the end of the year. Okay? Oh, in this case, it is a given information, but in real life, you will find the actual usage at the end. The car shows how many miles you have used or driven, right? Your car shows that, right? Yours does not. That means it has reached beyond salvage value, right? If it stops showing that, right? Okay. So let's compare these three, and we'll take a break. We'll compare the three methods, and we'll take a break. So we have, again, in the first year, 15,000. Second year, 13,000, 30,000, 20,000, 25. So based on each year's usage times the rate is going to be the depreciation expense. And it varies, as you see, 1,800 in the first year, 3,600 second year, 2,400, goes up and down. It depends on how much you have used it. Is that clear? If we compare the three, you see the depreciation varies among the 3 years. In the first year, it's 2,400. Double declining is 5,200. Units of activity is 1,800, and so forth. So, but at the end, it will be 12,000, right? All of them will go to 12,000. Just one little thing left about the depreciation, and let's do that, and that is accounting for a revised estimation. So let's say you purchased an equipment and you thought that it has a 5-year useful life. After 3 years, you re-estimate and you see that it actually has a useful life of 8 years, right? That means depreciation calculated thinking that it will last you 5 years, right? It's already gone. You don't have to go back and fix it. This is not considered an error in the previous financial statement. The reason is, when you reported that depreciation, you actually thought that the equipment has 5 years of useful life. So after 3 years, you think the equipment will last another 5 years. Whatever is left to depreciate, instead of depreciating that over 2 more years, you will depreciate that over 5 more years, right? 3 plus 5, 8 years. Okay, let's take a look at an example with numbers. Now, this company purchased an equipment for $510,000. It has a 10 years useful life, salvage value of 10,000. Okay. Now we have a $510,000 equipment, salvage value of 10,000. Using straight line, how much are we going to depreciate? Purchase price is 510, salvage value is 10. How much are we going to depreciate? What is the value that you're going to depreciate? 500, right? 500,000 minus the 10,000 salvage value. Depreciation has been recorded for 7 years on a straight line basis. So you will depreciate the 500,000 over 10 years, and you have done that for 7 years already. 7 years have gone of the 10 years. In the 8th year, you figure out that the equipment actually has a 15-year life, right? A 15-year life, and the salvage value at the end of the 15 years is going to be 5,000. So you have two estimations that you did at the beginning that changed. One is the equipment does not have a 10-year life, it has a 15-year life, and the salvage value at the end is not going to be 10, but it's going to be 5. So let's take a look at what happens. This is the original calculation. You have a $510,000 asset, subtract the 10,000 salvage value, and you have 500,000. Divide that with 10, and you have 50,000. So far so good. The depreciation should be 50,000 every year. You have done this for 7 years already. So 50,000 times 7 years. Every year 50, 50, 50, 50. You have depreciated 350. So now on your balance sheet, this is what you're showing. 500,000 purchase price, 350,000 accumulated depreciation, net book value 160,000. This is where you're at the end of 7 years. This is what your balance sheet is showing. At this point, you find out that the equipment is going to last for 15 years, and the salvage value is going to be. What do you do? Okay, so you have a net book value of 160,000, right? You have the net book value of 160,000, and now your salvage value is going to be 5,000. So you're going to start as if you're starting the depreciation again. 7 years have been 7 years are gone. Out of 15, how many left? 8. Book value is 160,000. Subtract 5,000 salvage value, which is going to be the value at the end, and you have 155,000. Divide that with 8 years, and you have 19,375. So the remaining 8 years, the depreciation expense is going to be 19,375. Debit expense credit, accumulated depreciation. Okay? All right, we'll stop here, inshallah. We'll take a 10 minutes break. We'll come back.